And we've got a first comment right here that we've got a big fan of your work, Lyn. Thanks for all the great intellectual info provided within the Bitcoin space.
Oh, I appreciate that.
All right. And with that, we are going to get started. Ladies and gentlemen, this afternoon, we've got Lyn Alden Schwartzer, who is the founder of the Lyn Alden Investment Strategy and is a contributing analyst to ElliottWaveTrader.net, covering equities and alternative investments. With a background blending engineering and finance, Ms. Alden blends fundamental research with a global macro overlay to find opportunities in markets around the world. Lyn, we're so happy to have you this afternoon. The floor is yours.
Thanks for having me, and welcome everyone. And I'm going to share some data and talk about some of the opportunities and challenges about this current macro environment and how we might, navigate it with, reasonable preservation and growth of capital. And so I want to start out by a chart that I share at a number of my MoneyShow presentations, which is the long-term debt cycle. Because I feel like this is an underappreciated concept that really kind of sets the stage for some of what we're going through in this environment. And so the chart on the left here shows the blue line is federal debt as a percentage of GDP, and the orange line is non-federal debt as a percentage of GDP, which mostly is household and corporate debt, and a tiny bit of state debt too, but it's mostly household and corporate. So it's mostly non-government debt. It's basically the debt of entities that cannot print their own currency, which is a pretty big difference. And so what we've generally seen is that, during like multiple business cycles, we build up a lot of debt in the system. We get lower and lower interest rates and higher debt as we go. And eventually you hit a breaking point. Eventually you hit zero interest rates, and eventually the debt gets too high. And so what we saw back in the Great Depression was we saw a huge popping of a private debt bubble. Then you had a long period of stagnation, malaise, deleveraging, currency devaluation. And then you had rising populism in the United States and elsewhere. And then that inevitably led to wars. And you started to see massive fiscal expenditures and huge debt burdens in response to those wars. And when we look over here, we kind of see a similar thing. We saw this, just more and more credit in the system until eventually we hit zero interest rates and we had tons of debt, and that was over speculative and it popped. And then once again, we had a decade of stagnation, a decade of deleveraging, a decade of rising populism. And unfortunately, we now have war. And then we also had, the pandemic hitting a highly leveraged system, which resulted in a big uptick in fiscal expenditures. And so what this chart on the right shows is the monetary and fiscal policy that's kind of behind this. So the blue line is the monetary base as a percentage of GDP. That's kind of a proxy for what the central bank is doing. The orange line is short-term interest rates. This chart's a little bit older. I don't update it too frequently because it's mainly a big picture chart. So obviously we'd see it a little higher here now. The two green areas kind of represent the first time they hit zero rates in a long time, which of course mirrors the banking crises and the tops of the private debt bubbles. And then the gray bars represent fiscal deficits as a percentage of GDP by the federal government. And so in general, we see that, in many ways, the last decade, the 2010s, mirrored the 1930s, less extreme in some ways. We had better technology. We had, different systems going through that type of macro environment, but a very similar situation from that point of view. And what we're now going through in the 2020s is unfortunately a lot like the 1940s. Now, hopefully without the same scale of conflict, but the same sort of fiscal-driven, inflationary, and more geopolitical type of environment to navigate. Another way of looking at it is, so the red line here is total debt as a percentage of GDP, which is all debts. It's federal debt, it's household debt, it's corporate debt, it's state debt. And that's on the right axis. So it's currently around 370% or 3.7 ratio. And the blue line is inflation adjusted interest rates. So I guess I should say CPI adjusted interest rates. Because inflation itself is kind of a nebulous topic. It's difficult to measure, but using official statistics, that is the inflation-adjusted short-term interest rate. And what we generally see is that when you have super high debt levels, it's very, very hard to maintain positive real rates. When you have debt equal to 370% of GDP, it's very hard to have, interest rates that are higher than the inflation rate. And we saw that back in the 1940s as well. This chart doesn't go back as far as the other one, but that's generally the problem that we find ourselves in. So back in the 70s, when they had an inflation problem, there are these bouts of inflation, but then they could raise interest rates pretty high. We saw back here. I mean, they raised interest rates super high to try to quell that inflation, and that was possible in a world where you only had 150% debt to GDP. But when you have 370% debt to GDP, they're a lot more limited on their inflation fighting capabilities without causing major debt liquidations. Another chart I think that's worth focusing on is the ratio of the stock market capitalization to GDP. This is for the United States. And so the higher this figure, the more value we have stored in our collective stock market as a ratio of our annual economic output. And we saw that back in this pretty high interest rate environment, you had pretty low levels because you had very high interest rates and you had very low valuations on equities. As interest rates structurally fell down, we had this huge ride up, eventually peaking in the dot-com bubble. That of course blew up and rolled over. They made a smaller bubble because a lot of the excess there was instead in the real estate market rather than the stock market, but that eventually blew up as well. And then we've had this huge uptick into what is a pretty epic peak that we had in the post pandemic stimulus world that is now pretty strongly rolling over. And a general theme in these big peaks is that we had super low commodity prices, right? So in the 90s and the early 2000s, you had very, very low commodity prices. And so the real input that we need at the base of it was very cheap. And so that allows for higher valuations and more kind of growth in these disinflationary type of things like tech. We saw a similar thing here after the pandemic issue. You had obviously oil hit negative briefly for a period of time, and then it was low. In general, we had this whole kind of multi-year period leading up to that was a very low commodity price environment, a period of commodity oversupply and cheap prices. Those tend to follow these large capex cycles. And so I would contend that going forward, we're unlikely to see a higher stock market to GDP ratio anytime soon, years or decades. Now, obviously that's not guaranteed, but essentially that I think that peak represents super low commodity prices, record large stimulus, and zero interest rates. And I think that it's going to be challenging to replicate that environment again. That doesn't mean that the stock market can't hit higher nominal highs, but it means it's going to be, I think, challenging to get to higher highs relative to economic output, relative to GDP. And so, in that environment, it's more of a malaise for the stock market and tends to be better in other areas. Could be sections of real estate, could be sections of commodities, could be defensive assets. Those tend to hold up better in those more challenging commodity expensive decades. Another way to examine this is by looking at the yield curve and the federal funds rate. And so the blue line is the yield curve. This is the 10-2 yield curve. I also like to look at other ones like the 10-year and 3-month yield curve. And the red line on the right axis is the federal funds rate. So the policy that the Federal Reserve is trying to do. And as you can see, they generally have trouble raising rates much higher once the yield curve has inverted. The yield curve is basically the market saying that the debt in the system is being pressured as is, the economy is slowing, and the Fed is doing their best to push up against that. And so obviously they're going to get a couple more rate hikes in, but it's already getting pretty heavy to keep going higher, which is remarkable because if we look back at this chart, obviously we're way below the inflation level, and yet the market's still giving the signal that it's becoming very challenging to keep pushing forward without pretty much causing an outright recession. We saw back in the inflationary environment of the late 70s that they were able to keep pushing it. That was Volcker pushing it despite the fact that you had a yield curve inversion. But as I discussed before, that was in an environment of 150% public and private debt to GDP, whereas today we have a 370% debt to GDP. And so it's basically lower interest rates cause problems at lower levels than what it took back then. And so that's a really kind of challenging environment when you have high inflation and yet also low interest rates comparatively. So a backdrop that's going on right now is that we have energy shortages and certain other real world supply constraints. And so the Federal Reserve and other policymakers are trying to suppress demand, to increase unemployment, and to reduce discretionary usage of energy and commodities and energy intensive goods and services in general. And the problem with that is it only works if we build new supply while we're suppressing that, right? Because if we suppress demand, it's like holding a beach ball underwater, and then you let it go and it pops back up unless we've actually fixed the underlying problem, which is that we are now pretty tight on energy supply. And so this chart shows in the blue line and the white lines estimated, this is the annual capex per year of large oil producers. And then the red line is oil consumption. So we saw it was a steady rising force, and then we saw the huge dip during the pandemic. That was a massive dip, and then we've since basically recovered, and now we're going into this, again, kind of a slower growing expected energy consumption at a time when we're still not, we've not invested much, and there's not a lot of investment on the horizon either. We also see, for example, looking at OPEC. OPEC has announced they're near max output capacity for what they're able to produce. So a lot of it during this time, OPEC had a lot of spare capacity that they could flip on like a switch, whereas now they've actually already ramped a lot of that up, and it would take quite a lot of investment to get a huge output from them. Basically, there's pretty tight real world constraints around conventional energy sources. And there's decline rates they have to go up against. And so it's harder to keep pushing up to more and more energy usage. And so that's the environment we find ourselves in, where we're holding demand down, but we still have a supply side problem. So we're kind of going through an engineered recession or near recession, however you want to look at it. There's kind of disagreements in the data for whether or not we're in a recession. That's why I'm calling it a malaise, right? It's a stagflationary type of environment, low or negative growth, nothing catastrophic yet, but a period of high inflation because the problems are emanating from the supply side, in addition to a large increase in fiscal stimulus money supply that we had over the past couple of years. And so in this type of environment, I'm looking for things that are inherently scarce, at least when I'm looking out with a 3 to 5 year view, right? So in any sort of 6-month period, things are going to be dictated by changing valuations, changing liquidity, how traders are positioned one way or another, kind of that fast money type of things. But we're looking at long term, I want to find things that are undervalued and that are scarce, that those represent the bottlenecks in the system. And so when we think about capex cycles, like let's say, for example, if you go back to this chart, in this whole run up, a lot of the capex was in disinflationary type of sectors. So the digital world, the dawn of the internet, the consumer internet. And eventually they overdid it. I mean, that's a well-known, there's just a lot of malinvestment by the end of that period, crazy valuations, projects that didn't make sense, and eventually they had to course correct. During this period, they instead, found themselves underinvested in real world things, commodities, housing, the growth of emerging markets. And so there's a lot of instead investment in there. And of course, by the end of it, they overdid it. They brought a ton of new commodity supplies online. They overbuilt homes. They got over leveraged, and they overinvested in the other direction. And then once again, we've been in more of this type of environment where we underinvested in a lot of the real world stuff. And we focused heavily on the digital world. And these cycles tend to go back and forth. If you go back to the 60s and 70s, for example, in the prior to that inflationary decade, you had a big period of growth stocks, big period of kind of disinflationary types of capex until they overdid it. And in the 70s, instead, you had that real world commodity oriented type of investment until once again they overdid it. And so, I would contend that we've overdone it in one direction, and we still have a whole decade to go, or at least many years of investing. So commodity cycles don't really end until you actually bring a lot more commodities online. And so I think that we're currently in kind of a pullback, a disinflationary period due to that demand destruction I talked about before, the Fed trying to curtail demand, but the supply side problem is still there. So I don't think this is going away anytime soon, even though it can certainly dip for 6 to 12 months. And so going back to investment opportunities, we had this whole big washout in energy pipelines. So this, for example, is Enterprise Products Partners. They've been one of the more conservative and large and diversified pipeline businesses in MLP. They have 25 years of consecutive annual distribution increases. And we can see that they had a period during the initial shale ramp up where they became quite overvalued. And then this whole era was a period of, oversupply in oil, lower prices, deleveraging throughout the industry. Then, of course, you had another cascade down during the COVID crisis, and a lot of pipelines blew up. A lot of them had to cut their dividends. A lot of them had challenges. This was one of the more conservatively managed ones, and so they managed to avoid the worst of it. They didn't have to cut their dividend. They were able to keep growing it, but obviously their price did very poorly. They went from overvalued to arguably quite undervalued, and they've since been in a recovery that looks a lot like the recovery of the post global financial crisis. And they currently yield over 7%. And there's a variety of pipelines like this. And it's interesting because they issue K-1 forms during tax season, so they don't really tend to attract fast money traders. Wall Street Bets is not going to be in a name like this anytime soon. And so it's really about kind of these long-term income-oriented compounding opportunities. And so I view a lot of energy pipelines as opportunities for people that want to have good long-term risk-adjusted performance. Because if you look at this chart again, I just continue to find that this is going to be a challenging decade for broad stock indices. And again, that doesn't mean they can't make new all-time highs, but it means that I think if you look back at the end of this decade, I think the inflation-adjusted returns of the indices are not going to be great. And instead, I think a lot of the returns are going to come from capital return, dividend payments, basically undervalued hard assets. This is a company that, for example, has, its average debt maturity is 20 years. It's pretty low cost of capital, fixed debt. And then it's got this big base of hard assets that are pretty challenging to recreate and that provide very stable cash flows at a rate that is higher than their, debt servicing. We can also look at in this environment healthcare stocks, right? So there's a big issue now between potential gradual decoupling between the United States and China, kind of a step back in globalization after a long kind of 25-year period of globalization. And so there are a lot of companies that I view as quite exposed to some major tail risks of worsening American and Chinese relations. And yet there are a number of other companies like health insurers and more domestic focused companies, and Enterprise would also be another example of this, where there's not a lot of that geopolitical exposure. There's other risks, of course, but there's not a lot of geopolitical exposure. And so Cigna is a health insurer and pharmacy benefits manager. A couple of years ago, they initiated a dividend, and now they plan to grow that dividend regularly. They also kind of gradually buy back shares because this is a low valuation, kind of steady growth type of company, not a company that needs a lot of capex and reinvestment. And I think that a combination of these more defensive and dividend-oriented names is something to focus on in this decade, both in the commodity sector and elsewhere, because I think that we still have a lot of richness in the valuation of broader markets, especially when we consider that, with higher commodity prices or slower growth or both, it's hard for them to have booming earnings growth to justify their relatively high valuations. We can also look at alternative monies. So gold, for example, is a common stagflationary go-to. And the reason for that is that during stagflation, it's very hard for companies to have great profit margins outside of perhaps commodity producers and some of the other industries that are specifically benefiting from the bottlenecks. But when you look at like the broad 60-40 stock portfolios, bonds obviously don't love in high inflation environments, and equities don't like slow growth environments, and they don't like it when their expenses are rising as quickly as their revenue due to a breakdown in efficiencies or higher commodity costs. And so some of the things that manage to do pretty well in that environment are alternative monies, because they don't have a profit margin to worry about. They're basically these things that are scarce compared to the number of fiat currency units that are going up dramatically. And now it's been ironic because, in the first half of this year, we had some of these very high inflation prints, and neither gold nor Bitcoin did particularly well. But that's, of course, because we're also in an environment where the Fed is trying to aggressively fight back. I mean, they've been, going back to this chart, they've been hiking rates at the fastest pace they've done in decades. They're trying to do their best to curtail demand. We've had no broad money supply growth in 6 months, which is, kind of a multi-year record. And so the actual inflation that we saw was the money supply growth from a couple of years ago. And now we're kind of in the hangover phase where it's showing up more in prices and the central bank's trying to fight back. But when we get to a point where it becomes pretty hard for the Fed to keep fighting back because of how much debt is in the system, that's when I think that these kind of alternative monies probably have another leg up higher. So gold's been a lot less volatile, but it's been kind of disappointing since the early phase of the pandemic. And of course, Bitcoin has done very, very well from the pandemic, but it's also done extremely high downward volatility from its peak level. And this chart, the orange line, this is Bitcoin, and the orange line is the on-chain cost basis on average. So it's basically, the accumulated cost basis, and it's only a couple times in history, about 5 times in history where it's kind of gone below its average cost basis. And so that's historically been a pretty good opportunity. And with gold, I continue to expect kind of a cup and handle pattern breakout, where once we get past this period of Fed tightening, I think we can see another leg higher in gold. If you look at gold priced in many other currencies like euros, yen, some of these other currencies that have not held up as well, many of those, gold's either all-time highs or nearly so. The chart looks a lot more constructive, whereas in this strong dollar environment of the Fed fighting back pretty aggressively, the dollar price of gold has been pretty lackluster. And so basically, to conclude, I find this environment that, despite the fact that I think we're in a near-term pullback in inflationary pressures, because we have demand destruction kind of outweighing some of the supply side issues, I think it's pretty clear when looking at the energy environment in detail that we don't really see supply relief coming anytime soon. And that, structural inflation issues, I think are going to kind of be like whack-a-mole this decade, where, we can get them under control for periods of time, but that due to those real world constraints and high debt levels, I think it's going to keep returning until we have a more kind of permanent solution in place that gets some of those cost pressures under control, which normally only happens after a long period of CapEx. And so in that environment, dividend-oriented investments, basically cash flow producers, as well as alternative monies, I think are the areas to kind of focus on, as well as, of course, the broad commodity sector, especially if you can, use trend following or other ways to reduce volatility, I think are the places to emphasize going forward. And I'm happy to answer any questions that might come up. Thank you.
All right, Lynn, we've got a few questions here. There's one here that's a loaded question, couple parts to it. So Powell cares more about 18-month forward, less 3 months rate than 2-year, 10-year spread. Also, Powell does not see any recession. Where do you see the neutral rate by the end of 2023?
So he is looking at a bunch of other variables. We see from forward rate expectations that they're pricing a cut by next year. So they expect that the Fed is indeed going to continue raising rates in the next several months, and then it's going to find themselves cutting rates in a recession. And I think that's probably reasonably accurate. I think there are a lot of variables that can influence that. What happens with the war in Ukraine? What happens with what happens with certain fiscal programs? What happens with all sorts of outcomes like that? But I think that basically we're in an environment where, unintuitive to many people, the neutral rate, meaning the rate at which the interest rate at which the economy kind of starts slowing down rapidly, is probably lower than people think it is because of how much debt is in the system, despite the fact that inflation is high. And so if I go back to this chart, what makes kind of the outcome of a public debt bubble different than almost every other environment is that you get high inflation and yet still low rates. In most other, in other inflationary environments, like the one we had in the 70s, when you had low debt, you had high inflation, but then you had high interest rates to compensate for that. And I think in this type of environment and this type of environment, so the 2020s and the 1940s, and this also applies to many other developed countries, I think that the neutral rate is going to be probably lower than the market expects on a long-term basis. And I think that that's where you're going to get some of this economic malaise that I'm talking about, as well as some of the currency devaluation that can lead to decent performance down the line of commodities and alternative monies.
All right, wonderful. Let's see, we've got another question here, which is what catalysts are needed to force the Fed to pivot?
So I'm looking for a handful of ones. One would be official unemployment rate going well over 4%. So right now we see some cracks in the labor market. We see rising initial jobless claims, falling labor participation, and a divergence between household surveys and establishment surveys about how many jobs are in the market. But either way, also we have wages that are growing more slowly than inflation. But either way, we still have a low official unemployment rate. And I think until that goes up, it's going to be pretty hard for the Fed to pivot. Another one to watch is the liquidity of credit markets and or the treasury market. And so if you get some sort of disorderly breakdown in some of those kind of core systems, I think you see the Fed come in and use various levers to reliquify the market. And I think they'll be subtle about it. I think you could see, for example, changes to bank leverage ratios and things like that to allow them to absorb more treasury issuance when we start to get to that point. So I think they still have a lot of tools to use, but that they won't use those until they have either a major breakdown in liquidity or unemployment.
All right, we've got a few more questions here. Let's see, profit recession and further rate hikes seem to be a given. So if so, what sectors are the best hedges in this environment?
So I think in the near term of rising rates, I think defense is the way to go, and that's why I like things like like conservative energy pipelines and healthcare stocks, cash, gold, and basically these kind of alternative defensive assets. When eventually you do get a Fed that's unable to keep pushing up, I think that's where you can kind of shift into some more risk. So I think it's an environment where you want to be diversified, and you want to focus more on the defensive sectors and ones that produce a decent yield, so that even in like a choppy sideways environment, you can still get some degree of positive return over time.
All right, wonderful. We've got another question. And what is your take on owning big tech stocks like Apple or Microsoft in this environment that you're projecting?
So I think we can still have a bear market rally in some of those names. And so, for example, if you start to see, and we already seen this to some degree, a reduction in forward market expectations about Fed hiking, that allows some of the valuation pressures to get off of those big tech stocks. However, I think overall, because they're consumer oriented, that their growth is going to be slower this decade than it was the last decade, as well as the fact that they're much larger now. They've kind of reached market penetration to a higher degree. And so I think they're going to have slower growth. And then some of them also have pretty big tail risks associated with global supply chains, namely China. And that if tensions increase, and if they have to do a lot of capex to relocate a lot of their business partnerships and their manufacturing facilities, that's a cost pressure. And so there are individual names that I like there. I think, for example, Amazon still has opportunity to grow. And I think that there are a number of kind of, I like Adobe, for example, software producer. There are select tech stocks and growth stocks that I like a lot. But I think that investors should be quite kind of selective with those, because I think that they have a lot of idiosyncratic risks, and then many of them are still rather expensive and aren't kind of depressedly priced at this point yet. They're still kind of expecting a lot of good earnings growth this decade that I think has a risk of not materializing for a lot of them.
All right. And we've got another question. Do you think we are in a stagflation environment like the 1970s?
I do, but I use the 1940s as a closer comparison. Basically, I think that this environment you see here matches a lot of what we're seeing now. Whereas I think the 70s was a low debt, high rate environment. There's also different reasons why we had that inflation. So in the 1970s, we had a demographics boom. Basically, the baby boomers started entering their home buying years. And so you had a huge uptick in home construction. You had a lot of demand. Whereas 1940s, and a lot of that was driven by bank lending inflation. So a lot of banks were lending pretty aggressively, creating a lot of money supply in that regard. Whereas 1940s, you didn't have a lot of bank lending. Instead, you had fiscal stimulus, you had fiscal deficits. And even though that was war related, a lot of it was focused on domestic economies. It was building manufacturing facilities. It was returning GIs to college, things like that. So you had a lot of that, what is otherwise termed fiscal stimulus. And so I think we're closer to that type of environment. The biggest similarity we have to the 1970s is that in 1970, domestic US oil production peaked after like 100 years of structural going up. We then entered a multi-decade decline in US oil production. And that didn't reverse until the 2010s uptick in shale, basically unconventional oil sources. And so that kind of supply side energy constraint is the closest thing from the 70s that I think we have impacting us now. So yes, I would describe us as being in stagflation and an economic malaise, with the caveat that the 1970s is not a perfect analog.
All right, Lyn, well, looks like we have hit our time. So thank you very much for the presentation. Thank you to our attendees. We've got more content coming up, so we'll see you on the next one.
Thank you.